Riches aren't accidental. They're constructed, tended with care, and safeguarded through the ages. While newly wealthy people show off with sports cars, volatile crypto plays, and risky startup bets, those with generational wealth follow an entirely different playbook. Their approach to money is understated, deliberate, and built to endure for hundreds of years. Here's the intriguing part. What if the wealthiest dynasties on the planet, the ones who rarely appear in tabloids, revealed precisely how their fortunes keep compounding year after year? It isn't chance, and it's certainly not a winning lottery ticket. It comes down to acquiring the right assets at the right moment. Before going further, hit that subscribe button, because this isn't your typical flashy get-rich-quick content. This is an inside look at how families who've held wealth for centuries actually think. These families invest in holdings that keep multiplying their fortune even while they're not paying attention. Now let's uncover the closely held financial habits that old money families seldom discuss. Rule number 1: they don't follow fads. They invest in time itself. Unlike newcomers to wealth, established families understand that building riches isn't about guessing the next big thing. It's about staying patient. Across generations, dynasties such as the Rockefellers, Rothschilds, and Vanderbilts grasped one essential idea: the world operates in cycles. Yet time consistently rewards those who hold on to real, lasting value. While newly minted millionaires gamble on meme stocks or the latest cryptocurrency, established wealth focuses on lasting value. They ask themselves what holdings will still matter a century from now. That's why their investment mix looks so different. They acquire farmland, rare artwork, historic properties, even woodlands and mineral rights. These are holdings that build value gradually over decades, immune to short-term swings. Real estate sits at the foundation of generational wealth. If one investment category defines old money, it's property, but not ordinary property, the irreplaceable kind. Picture prime Manhattan land, vast English countryside estates, or centuries-old French vineyards. These aren't simply properties, they're effectively monopolies. Once secured, nobody else can create another premier Bordeaux vineyard or claim another block on Fifth Avenue. Consider the Duke of Westminster as an example. His family holds roughly 300 acres of prime London property, passed through generations. This isn't wealth that evaporates during downturns. It's wealth that grows as cities develop and the appetite for scarce locations intensifies. These families don't just acquire property, they acquire legacy. They prioritize irreplaceable locations, oceanfront, urban cores, historic districts, legacy estates, or castles that grow more prestigious with age. They also hold income-producing property, rental units, commercial buildings, hotels. And here's the key insight: they almost never sell. Rather than selling, these families hand properties down as anchors for future generations, letting value climb steadily while rental income flows in along the way. Land and farming represent ownership of the earth itself. Old money grasps a basic reality: people will always need to eat, and those who control the land control the supply. The Rothschilds, for example, discreetly invested in vineyards, olive groves, and farmland. America's Mellon family acquired vast stretches of agricultural land that continue generating income today. Old money plays the long game, and now you know their playbook. If this opened your eyes, like, share, and subscribe for more insights the wealthy rarely share. Let's continue. Farming delivers consistent income from crops, livestock, or wine production. It also protects against inflation, since food costs climb alongside demand, and its value is built in. Land is limited, and farmland only grows scarcer as populations expand. Even now, figures like Bill Gates and Ted Turner are snapping up enormous farmland holdings, following a strategy that's centuries old. The reasoning is simple. Technology sectors can crash, and currencies can lose value, but the need to feed people never disappears. Rare collectibles, art, antiques, and enduring assets. Here's another insight. Old money doesn't acquire art merely for decoration. They buy it because art ranks among history's most dependable wealth preservation tools. A Picasso or Monet represents far more than canvas and pigment. It's an asset that appreciates, one that beats inflation, and frequently outperforms stock markets. Unlike equities, art offers portability, tax benefits, and exclusivity. Families such as the Medicis during the Italian Renaissance, or the Gettys more recently, amassed fortunes not just through oil and finance, but through priceless art holdings. Those same collections are now valued in the billions, vastly exceeding their original purchase prices, and it extends beyond art. Old money also collects antique furniture, handcrafted pieces that accumulate cultural and historical worth, along with rare jewelry, heirloom diamonds, colored gems, Fabergé eggs, and classic automobiles like limited-run Ferraris or Rolls-Royces that achieve iconic status. For old money, these aren't mere indulgences, they function as financial safety nets. Should the economy crumble, a diamond necklace or a Van Gogh can be liquidated for tens of millions anywhere on the globe. Stocks, approached differently. You might assume old money steers clear of the stock market, but that's not accurate. They do hold equities, just not the way ordinary investors do. Rather than day trading or jumping on the newest tech IPO, they invest in established blue-chip firms with long track records of dividend payments. Companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola, businesses that have endured for over 100 years and are likely to last another 100. The distinction lies here. They aren't seeking a fast profit. They purchase stocks the same way they acquire estates, intending to keep them indefinitely. And those dividends, compounding across generations, transform a modest stake into substantial family fortunes. It's common for these families to set up trusts that distribute steady dividend income from such holdings, guaranteeing that each generation benefits without ever touching the underlying assets. Private equity and discrete business ownership. Old money doesn't settle for owning shares. They acquire entire companies. They put money into private equity, purchasing enterprises that generate dependable cash flow. These are frequently unglamorous, low-profile businesses operating quietly, yet producing consistent profits. Think logistics companies, utility providers, manufacturing operations, or agricultural processing firms. This represents one of their most closely guarded strategies. Unglamorous companies build lasting fortunes. While trendy startups rise and collapse, family-run utility companies or waste management firms produce reliable income across decades. The Mars family, for instance, didn't stop at candy. They quietly expanded into pet care and food production as well. They own enterprises that people patronize daily without giving it a second thought. Precious metals and natural resources represent the oldest form of protection. When markets crash, currencies fluctuate, and empires fall, something endures. Gold, silver, precious metals. Old money has consistently protected its fortune through physical assets that can't be printed into worthlessness. The Rothschilds were known for trading gold bars long before banking became commonplace. Royal families stored vaults of silver, while aristocrats passed down jeweled crowns, not merely as status symbols, but as genuine wealth reserves. Even now, many dynasties maintain private holdings of gold bars, rare coins, or precious stones. These assets carry universal value. Gold holds worth everywhere on Earth. They guard against inflation, often rising when currency purchasing power falls, and they protect against crisis. During wars or political instability, portable wealth can determine survival. But old money's resource strategy goes beyond gold. They also invest in natural resources, oil, gas, timber, and mineral rights. Whoever controls what lies beneath the ground often controls what comes next. South Africa's Oppenheimer family built generational wealth through diamonds. The Koch family transformed oil refining into a vast enterprise, while European aristocratic families quietly held enormous forests, profiting from timber while preserving the land for future generations. For old money, this isn't about luxury alone, it's about controlling necessities. Owning resources means owning not just wealth, but influence, Trusts and foundations function as invisible fortresses. Here's something most everyday investors never glimpse: the concealed structures that shield old money fortunes from erosion. It's not solely about acquiring assets, it's about protecting them over time. That's the role trusts and family foundations play. Trusts operate like unseen strongholds. Families place their fortunes within these structures. Property, equities, art, and businesses all become protected from steep taxation, legal claims, and irresponsible heirs. This guarantees that even when one generation mismanages money, the family's core wealth survives. Family foundations take this protection a step further. They look, on the surface, purely philanthropic. And indeed, these families donate substantially, funding hospitals, museums, and universities. But these organizations double as tax protection mechanisms. Wealth gets preserved through deliberate charitable giving. They become tools of influence, too. Backing education and policy initiatives builds enduring power, and they serve as legacy builders. Families cement their names in history, extending beyond mere finances. Consider the Ford Foundation, the Rockefeller Foundation, and the Carnegie Endowment. These weren't simple charitable acts. They were deliberately structured to preserve wealth while simultaneously shaping society. For these families, generosity and strategic thinking are inseparable. Offshore havens are where quiet money rests. Here's another lesser-known fact. Old money doesn't concentrate all its holdings domestically. They deliberately distribute wealth across offshore locations: Switzerland, Luxembourg, Monaco, the Cayman Islands, Singapore. The reasoning involves diversification and protection. Offshore placement provides privacy, keeping fortunes away from public attention. It offers tax benefits, since favorable regulations help preserve capital, and it provides global reach. Investments aren't dependent on any single nation's risks. This strategy isn't new. For centuries, aristocratic families relocated gold, jewels, and even whole estates offshore to shield them from wars and revolutions. The Rothschilds operated banking branches across multiple countries, ensuring no single government could confiscate everything at once. Outsiders often view offshore wealth with suspicion, but for these dynasties, it functions as insurance. If one nation falters, the family fortune continues thriving elsewhere. Education, connections, and human capital matter too. Here's something financial statements won't reveal. Old money invests in more than assets alone. They invest heavily in people. Education gets treated as the safest, most enduring long-term investment available. This means more than standard schooling. It involves carefully selected, elite pathways: Swiss boarding schools, Ivy League, and Oxbridge education. Internships secured through family connections. The real goal isn't just acquiring knowledge, it's building networks. Old money recognizes that connections often matter just as much as possessions. By placing their children within influential circles, they construct networks of opportunity that extend across generations. A Rockefeller descendant doesn't simply inherit money, they inherit access to a network of executives, financiers, and decision-makers. A European aristocrat doesn't just inherit land, they inherit connections to royalty and world leaders, and these relationships frequently produce more wealth than any individual stock or property ever could. Patience, the philosophy underlying everything. Every old money investment decision rests on one unwavering principle: patience. While new wealth fixates on quick wins and viral success, old money operates on timescales of decades or centuries. They acquire things built to outlast fads, governments, and even currencies themselves. This explains why their holdings might seem unexciting to outsiders. Land, property, gold, art, dividends, trusts. Yet here's the genius in it. Unexciting equals durable, and durability is what builds lasting dynasties. For old money, wealth isn't about flaunting it now. It's about guaranteeing the family is richer tomorrow, and richer still a century from now. The ultimate secret: they almost never sell. If anything sets old money apart from everyone else, it's this principle: They acquire to retain. Most investors dream about the eventual payout. Old money doesn't operate that way. They don't view their holdings as opportunities for a profitable exit. They view them as foundations of stability. The land remains within the family. The artwork stays in private collections. The businesses continue producing income. And the fortune keeps expanding, quietly, behind the scenes. The objective isn't to cash out, it's to continue. And herein lies the great irony. While new wealth pursues speed, old wealth triumphs through patience. While others boast about their returns, old money remains discreet. And while the majority of fortunes disappear within 3 generations, old money endures, unchallenged. Old money plays the long game, and now you know their playbook. If this opened your eyes, subscribe for more insights the wealthy rarely share. Let us know your thoughts on the comment section below.